Well, good evening, everyone. Welcome to the Ross Parsons Tax Lecture. My name is Simon Bonnet. I'm the Dean and Head of City Law School, and it's my pleasure to welcome you. First things first, acknowledge country. As you walked in through the door, you will see an acknowledgement, Nyini Galawagan Mari Buduri Gadi Nurda, which means that we meet together on this beautiful Gadi country. And this, in fact, is a part of our facade of the law school, which was instated only 18 months ago, acknowledging these amazing trees, plants that grow endemically around the campus. And they're called Gadi, and hence Gadigal, meaning people of the Gadi. I'd like to pay respects to the elders, past, present, and emerging, who have obviously been on this land for at least 60,000, possibly more, years, caring for country and administering law and doing justice. Tonight, I'll hand over the podium to my colleague, Professor Richard Ban, who will tell us a little bit about the lecture, but also about the speaker tonight, our colleague Graeme Cooper, who of course is an emeritus professor. I don't know whether that's the first point of public announcement, but in acknowledgement of the very significant contribution he's made over his professional life to the discipline and to the university. In the next transition phase, he is still part of the community as an emeritus professor. Anyway, I'll hand over to Richard.
Thanks, Simon. I'm the lucky one. I get to speak and I've done none of the work. I'll tell you who did the work later on. It's a great pleasure for me to introduce Graeme, although he needs no introduction to any of you, to give the Ross Parsons lecture, which to some degree has been in abeyance for obvious reasons for the last few years. So it's really great to get people back in the room and to be able to do it properly. Ross, as was Graeme said in his little spiel for the talk, wrote a paper in 1986 called Income Tax and Institution in Decay. Graeme is taking that theme with the still within exclamation marks after it. I wrote a paper a few years ago channeling the same theme, but in defense of the income. So I might have a few words to say about Graeme's talk afterwards, but probably not, probably not. I've known Graeme, I think, at least consciously since the mid-80s when he was a student in Income Tax 2, and I think won a prize for Income Tax 2. He won a number of prizes in his master's and graduated with first-class honours. He also did his undergraduate BA in philosophy, and that's a theme of Graeme's life. He's always maintained an interest in philosophy. He did a jurisprudence diploma after he graduated from law. He thought law was a bit tedious, so he went into jurisprudence for a bit, but then he came back to tax law, which sort of seems a significant regression. Graeme wrote a wonderful paper for his honours paper in the LLM, which I had to mark. And that was the first time I really came to grips with Graeme as a scholar. And it was way over my head. It was about accounting and income tax for deductions. And I'm not an accountant, so I learned a lot from the piece that he wrote. Shortly after that, he went to UNSW for a while in with a number of UNSW colleagues here tonight, and then he came back to Sydney. And although Graeme and I have notionally been colleagues since the late 80s when he came back to the law school, we seem to have a life where we're doing the same kind of projects, we're working on the same program, we're writing the same kinds of articles, sometimes together, but we rarely actually saw each other. I went off to Paris for 3 years and came back, and then Graeme went off to Paris for 3 years as soon as I got back. So he had time at the OECD, and then he went and betrayed us and went to Melbourne and set up their tax program, or got it on its feet. And we have Miranda here, who's now one of my students, and I think one of Graeme's students, who is the head of the tax program at Melbourne Law School nowadays. And again, Miranda Stewart will be known to many of you. Graeme went off to America after he'd finished his degree here, and he did 2 LLMs over there, one at Champaign-Urbana, I think it is, one of those cold Midwestern universities, but a really good university. And then later at Columbia in the 90s, where he did his an LLM and then his JSD, I think they call it there. And in that, he also was picking up economics. So again, he's way ahead of me, because I'm a kind of neophyte in economics. I like talking to economists. I really just agree with a lot of what they say, particularly the government ones. But Graeme also has, over the time, sort of developed that kind of approach into teaching. And Graeme also had a significant track record in teaching. He was one of the people, along with John Wade, who was at the law school back in those days, who set up the Legal Education Review in Australia, which happened many years ago. And then a number of law schools got money from what was then a good source of money, the Law Foundation of New South Wales. And that funded a teaching workshop for a number of years, where Graeme was one of the teachers of the teachers in the teaching workshop for a number of years. So he contributed greatly. I see Barbara nodding. Barbara went along as a new lecturer to that program, and she said it was absolutely eye-opening and wonderful. And many of you here will have experienced Graeme teaching. It is an experience. Many of you love him for what you learn from him. He came back to Sydney in the early 2000s. We were able to entice him back, and he's been here ever since, writing, researching, running the postgraduate tax program. We've tried to sort of, in that program, we do the hardcore technical detail, but we do it with a policy overlay. So we try to teach the students, this is what it's supposed to be about. Now, here's what it actually is. And, you know, how can it be changed to maybe get a bit closer? Or maybe Graeme is despairing that it ever will get any closer to what the income tax should be. I don't want to take any of Graeme's time. So with that, I think even a little bit ahead of time, I might get underway with the lecture, give Graeme and Miranda a bit of time to talk about it. Thank you.
Thank you very much. I've had the honour over the years of being invited to do a couple of public lectures, and I worked out that there were really 3 golden rules for a public lecture. The first is to remember to thank people first. So I want to thank Richard for the introduction. It was a bit like being at my own funeral, which is good. If you're available, Richard, I might book you for a return gig. And then to thank Richard and the rest of the tax program for the invitation to do the Parsons lecture. Previous Parsons lecturers have been scholars of great distinction, international reputation, and great accomplishment. No doubt there will be a Senate inquiry into what went wrong, but I'm very pleased to be here. I have I've kind of entirely brazenly appropriated as the title for tonight's lecture, the title of a paper done by Ross Parsons on the eve of his retirement. It gives his caustic assessment of the body of law which occupied so much of his professional life. On the occasion of my retirement from full-time teaching at the law school, it seemed fitting to revisit that paper. The symmetry of the two retirements appeals to my sense of neatness. In his lecture, Parsons' assessment of the income tax was completely and unreservedly damning. The income tax is an institution whose policy beyond the pursuit of revenue was always obscure. It is an institution that borrowed a concept, income, from another institution, the trust, so as to spare its makers too much of a drain on their creative imagination. A principle of trust law that would direct that in the circumstances an item should be allocated to the remainderman because this was the presumed intention of the creator of the trust is a strange basis for a conclusion that this item is or is not one in which the state should share through a tax. The income tax lacks any single underlying principle which is relevant to its function of sharing command over resources between individual and government, and which can give it coherence and a claim to fairness. Without such an underlying principle, it earns no respect, it deserves none. His conclusion was that the income tax should be abandoned or at least significantly contracted in favour of a broad-based consumption tax delivered in the form of a value-added tax. The future belongs to consumption taxation, to a value-added tax, as the Asprey Committee recommended. The committee, in its more romantic moments, there's a thought for you, romantic moments, envisaged the ultimate demise of the income tax. We cannot go it alone in abolishing our income tax, but in company with other countries, we will shift away from the income tax. The more we try to strengthen the tax, the more the lack of coherent principle will become evident and the less our respect for the tax. As a prophet, Parsons made a pretty good tax lawyer. 15 years later, Australia did introduce a value-added tax, but that development was not accompanied by any withering away of the income tax edifice. The evidence of the last 2 decades is that the income tax has only grown in complexity and in importance. Since 2000, the complexity of the tax base has grown with regimes. Now, this won't mean anything to some of my colleagues in the audience, with regimes like the PSI rules, outbound thin cap, Forex, consolidation, value shifting, TOFA, trust streaming measures, the MAL, MIT withholding tax, the AMIT regime, the DPT, cross-border hybrids, and shortly we will have Pillar 1 and Pillar 2. I don't think I needed to retire because I could be gainfully employed for the rest of my life just trying to work out what the last 20 years actually did. This is quite apart from re-legislating some existing regimes like rewriting inbound thin cap or superannuation or employee share schemes or Part 4A or transfer pricing. And that is not to mention the routine tinkering which happens at every parliament. And the growth in verbiage in the income tax has not been accompanied by any decline in its significance as a source of revenue. Company tax just keeps on growing, and most of it is paid by 10 companies, miners and banks. The rest are a waste of space. I'm sorry, SME practitioners, your clients are rats and mice in the system who clog it up. GST, on the other hand, is almost completely moribund. For example, in the 2005 budget, so that's 5 years after the GST started, the government estimated it would collect $38 billion from GST and $167 in income tax. 10 years later, the budget showed a fairly consistent 30% increase in the revenue of both taxes. They were growing in accordance with the economy. But by 2020, GST has fallen off a cliff. GST went up over those years by 4%. Income tax went up by over 20%. In short, GST did not gradually replace the income tax. And I doubt that it ever will because of John Howard's very unwise decision to exacerbate the problems of vertical fiscal imbalance in our federation by making the Commonwealth bear the opprobrium of changing the tax base while getting none of the revenue for that pain. But to return to my main theme, while I admire Parsons' acerbic assessment of the income tax, I disagree with the thrust of the argument and will offer a rather different explanation of what is wrong with the income tax. And as Richard said, I'm not the first person to take that view. I'm following the footsteps of John Prebble and Richard Van, so I'm in good company, although their critique is different to mine. It may seem strange to invoke the title of Parsons' lecture, only to disagree with it. But one reason for doing this lies in the image with which he begins the paper. He likens the income tax to a supernova, to a star in its death throes, which increases dramatically in size and intensity before collapsing upon itself. I like the image, and I want to add another one. The income tax is like a defective jigsaw. Important pieces are missing. There are lots of duplicates. The pieces we are trying to assemble have been smudged, and the image we are trying to replicate has been deliberately blurred. For almost 25 years, I've written on many occasions and at tedious length about the problems of Australia's income tax legislation, and I'm going to revisit some of that work tonight. Some people will say I'm like a broken record. I like to think of this as my greatest hit or hit or whatever, yes. In part, that's because I was personally involved in some of the experiments which have been visited upon the tax community, being appointed by the government as a member of the Committee of External Advisors for the Tax Law Improvement Project. I don't usually admit that in public. The 2002 project on the tax value method, the 2011 revisions to Part 4A, and a couple of others. And I should add, I don't recall ever being asked to sign a confidentiality agreement. A key focus of that 25 years worth of lectures and articles has been on the design and the execution of the income tax. By design, I mean the architecture of the tax law, the assembly of sections into divisions, divisions into parts, parts of statutes that have to fit with other statutes. By execution, I mean the very odd drafting style that's been used by succeeding generations of tax drafters since 1995. Tonight, rather than read all of that work to you, I'm going to focus just on one sliver, which is execution, the curious way in which our tax laws are drafted. Another reason for choosing this topic is that I recently attended the 2022 Melbourne Tax Lecture that Miranda organised, which was delivered by Judith Friedman, Emeritus Professor of Taxation Law and Policy at Oxford. Her topic was vagueness in tax law. And she advanced the argument that vagueness in tax law is not only unavoidable, it can be desirable. Her address referenced the work of Timothy Endicott, Venerian Professor of English Law at Oxford, and his book, Vagueness in Law. So I wanted to use this lecture as the impetus to force me to consider whether vagueness and imprecision do indeed have redeeming features. Having spent so long being so vociferously attacking the peccadilloes of tax drafting, did I miss something? Was I wrong? Was I misguided? Did I simply misunderstand? The answer is no. We'll get to that point later. The third reason for choosing this topic is simple compassion and fellow feeling. There are people here tonight, and I'm looking at some of them, for whom the world of tax is not just unfamiliar, it is positively repellent. So the decision to attend a lecture which has tax in the title has come at some personal jeopardy. There was always a danger I would talk about tax. But whether it's tort or family or crime or consumer protection or environmental law or name your field, law is always about words, hopefully my topic being about words, will make tonight's event a little less unpalatable in the interval until the booze arrives. So this address is about words. I'll divide my topic into two parts. In the first part, again, I want to talk about some of the causes and of the examples of the imprecision, uncertainty, and ambiguity seen in the particular backwater of Australian law that we call tax. In the second part, I want to challenge the argument advanced by Judith Friedman, Timothy Endicott, and others that vagueness is not undesirable, that imprecision has virtue. I'll be using examples drawn mostly from tax law with a little excursion into corporate law, but hopefully listeners can supply their own examples drawn from other bodies of law. Part 1, the pursuit of linguistic imprecision, or as I prefer to say, Jack and Jill go drafting. Listen to legal practitioners for long enough and the conversation will inevitably turn to legislative drafting and a shared litany of complaints. Statutes are prolix, wording is cumbersome, there's too much jargon, usage is arcane, punctuation is hard to find, Parliament's intention is opaque, the language doesn't even seem to execute what we thought was the intention. The new provisions are incompatible with existing ones, and so on, and so on, and so on. In 1993, the Joint Committee of Public Accounts and Audit in the Parliament was convinced by the rather doubtful proposition that a large part of the complexity of the income tax could be traced to problems of language. If language was the problem, well, language could be the solution. Complexity could be solved, it was said. The scope for disputes would be minimised by changing the words on the page. The committee's report led to the creation of the Tax Law Improvement Project, which gave us the textual changes we have become familiar with in tax law and have spread to other Commonwealth Acts. The Tax Act now boasts pictures. There are guides and notes and examples and lists and tables and typefaces and asterisks, all combined into a melange of operative and non-operative provisions. I note with dismay that this infection has spread to other statutes, albeit in a less virulent form. Corporate lawyers, watch this space. According to the authors of the revised tax legislation, linguistic changes would silence the complainers. For many years, the income tax has been criticised for being too difficult to read and understand. A very formal and detailed style of language used in the law makes its true meaning hard to find. This project will completely rewrite the income tax legislation. It will re-express existing law in language that can be more easily understood by its readers, which will reduce excessive compliance costs to taxpayers brought about because of the present state of expression and presentation. Now, to some extent, the Tax Law Improvement Project was the child of the plain language movement of the 1990s, which had drawn to our attention some of the problems of obscure and arcane terminology. And it's true that the modern drafting style in the Tax Act avoids many terms of art, a lot of jargon, but a few examples show that the result is not necessarily greater clarity. One example is the phrase economic benefit, which first appeared in the rules about depreciation and then value shifting, but the term didn't catch on and it was abandoned in favour of another term, financial benefit. It's hard to see that economic benefit or financial benefit provided any more clarity than the phrase we had been using for hundreds of years, whether in money, property, or services. That was a phrase we understood, but apparently that's jargon. And so we had to get rid of money, property, and services because their meanings are too obscure, and we had to use economic benefit until it became financial benefit. But the new terms raised questions. So, is an enhanced reputation an economic benefit? What about natural love and affection? Is that an economic benefit? Do we now treat a promise to pay as being the thing we should look at The promise has got value. Presumably it's an economic benefit. Or do we look at a flow of funds? Or do we look at both? What happens if an amount turns out not to be a benefit, if it turns out to be burdensome? I've given you property, but the property is encumbered. I don't ever recall having to ask those questions about the phrase, whether in money, property, or services. Another favourite example of mine is from the rules about transactions occurring in foreign currency. And Mr. Hurst and Mr. Frost here can smile knowingly. I'm going to inflict this upon you because when I said I wasn't going to do a lot of tax tonight, I was lying. And you should really just bask in the obnoxious drafting here. Notice, so the section reads, Forex realisation event 2 happens if you cease to have a right or a part of a right to receive foreign currency, and the right or the part of the right is one of the following: a right or a part of a right to receive or that represents ordinary income or statutory income, other than statutory income that's assessable under this division or division 102, a right or a part of a right created or acquired in return for you ceasing to hold a depreciating asset, a right or a part of a right created or acquired in return for you paying or agreeing to pay an amount of Australian currency or foreign currency, a right or a part of a right created or acquired in return for the occurrence of a realisation event in relation to a CGT asset you own, and none of paragraphs 1, 2, and 3 applies, and you did not cease to have the right or the part of the right because you disposed of the right or the part of the right within the meaning of section 77540. Now, the point of inflicting this verbal excrescence upon you is simply to show that drafting in words in one syllable or less is no guarantee of clarity. None of the words used are terms of art, but their apparent simplicity is, for most people, simply mystifying. In case you were wondering, what the drafter was trying to say is, you got paid. Just over a decade later, fashions changed. There was a new black. The new black was principle-based drafting. Tax Law Improvement Project had given us words of one syllable. Tax Law Improvement Project would give us norms expressed as principles. The rule would be a principle unadorned by detail. It's one thing to avoid using terms that are esoteric and arcane. It's another thing to want to write rules that are deliberately vague and imprecise. That approach was a conscious decision. I have no doubt that the Office of Parliamentary Counsel can draft in many styles, but they were instructed to take a new one. Can you just vague it up a bit more? I can think of no field of writing where authors deliberately try to be mysterious, except perhaps for horoscopes. You will meet a tall, dark stranger. When I say tall and dark, and when I say meet, you get the point. I'll examine two examples to demonstrate the main difficulties with deliberately pursuing a policy of ambiguity. First is the problem of accurately capturing the principle, and the second is deciding what it does and doesn't do. So what was that principle again? My first example is TOFA, so the taxation of financial arrangements. Mr. Frost and Mr. Hurst are just basking in the glory because it was conspicuously chosen as the project to trial principle-based drafting. In the 2005 draft of the legislation, the basic definition of a financial arrangement, so this is the core concept in a regime directed to the taxation of financial arrangements. A financial arrangement was a legal or equitable right to receive something of economic value in the future. The explanatory material argued that this definition captured the principle of a financial arrangement by taking into account the common economic substance underpinning all financial arrangements. This is 2005. It's interesting that it was rather different to the definition of debt, which had been enacted 5 years earlier. That definition too claimed to capture the economic substance of debt. So we had two definitions. They were different. Both claimed to capture the essence of debt. One of them must be wrong. My money is on they're both wrong. The 2005 version, the general principle, defined the group of financial arrangements utilizing a single observable characteristic. Someone had the right to get something of value tomorrow. That was the test. But if you think about it, the only principle being captured in that definition is simply incompleteness. Somebody's got a right to get something of value tomorrow, so we aren't done yet. Right? That's what the definition is all about. Okay, so I walk into a store, the guy says that'll be $50. I say, there you are, there's the $50. Can you hold it for me while I go and get the truck? We've just created a financial arrangement. Right? I have a right to receive something of value in future. It was not a surprise when 2 years later, the definition of financial arrangement was substantially revised. The definition, which had been 5 lines, now occupied 3 pages. So now the regime would apply to a right to receive a financial benefit that has a monetary nature. Somebody decided money was kind of important to financial, okay? That's a major leap forward. So under the new test, money matters. And the second thing that was added was, we better look at what's on the other side. So I have to give, or I'm going to get money. What's the other leg of my incomplete deal? Do I have a corresponding right or obligation to provide something that's not money? So this was a fundamental reconception of the principle. We added in money, we looked at 2 sides of the transaction. But even with this reconceptualization, the scope of transactions covered was extremely broad. Every transaction in the economy, other than a simultaneous exchange, has got an incomplete component. So is every transaction in the economy now a financial arrangement? Well, the answer is yes, under that definition. That definition might capture at any time an unpaid seller or unpaid buyer, or an unpaid employee, a legatee under a will, a superannuant, a pensioner like me, a tort victim. At some stage in their dealings, these people will have a right to receive money and no offsetting obligation of non-money. But these rules were never meant to apply to wages and pensions and annuities and superannuation and tort payouts. And so the overarching principle had to be circumscribed again to ensure that a multitude of transactions could not be financial arrangements. Eventually, the principle just collapsed, and it collapsed by the insertion of black letter, highly technical exclusions, because the principle didn't work. And the way to solve the principle was to legislate a whole bunch of exclusions that would undo what was clearly an inappropriately broad drafting problem. The second problem with principles is not just the problem of getting it right, of getting the principle right. The other problem is, well, just what does this principle mean? Most countries will combine and for this I'm going to talk about consolidation. So even the tax lawyers in the room are starting to get nervous at this point. Most countries are going to combine the tax positions of related companies, the economic unit we call the corporate group. Most tax systems will combine the position of multiple companies, and they'll do so in one of 2 ways. Typically, one way is to say, we will shift a bunch of valuable tax attributes around within the group. You've got a thing, do you really need that? If you don't need it, look, you can give it to this guy. Right? We had that system for a while. Another system is look, you're a guy, why don't you just get in bed together? We'll just amalgamate you. okay? And your interpersonal relationships we will eliminate, but we'll leave in place the stuff that you did with outsiders and you did with outsiders. That's aggregate and eliminate, which is the way the US does consolidation. Australia, of course, could not do what the UK does with attribute transfer or the US does with aggregate and eliminate. We decided we were going to take a third approach. And the third approach says, you think you're a company, you think you're a separate legal entity, sorry, you're not. Okay, the approach taken for tax purposes was simply to undo the fact of separate legal personality and the fact of incorporation. And I think the legislative history is very, very clear that that's what the drafters thought they were doing. Okay, the corporate group collapses into one thing, that one thing being the head entity of the group. It was more than a little surprising, therefore, to read the judgment of Justice Pagoni in Channel Pastoral, where His Honour says, the statutory direction in consolidation is not that a subsidiary is to be treated as non-existent, or that it ceases to be a taxpayer, or that it does not derive or make assessable income or gains, or that it does not incur losses or outgoing. The requirement that the subsidiary is taken to be part of the composite whole is an indication of a statutory direction that the parts continue to exist as parts of the composite whole and that their individual portions will be taken into account in the calculation of the aggregate composite whole. He thought we had legislated the American system. It could not have been made clearer in the legislative history that we had not done that. But he said it. I don't know whether this is a Victorian thing, Miranda. But his judgment was then endorsed in a subsequent judgment in Glencore Investments by Justice Davies, who said, yeah, looks right to me. At which point the ATO has conniptions, as does the profession, because the ATO and the profession thought they understood the way this system worked. So the ATO then had to issue an elaboration of their ruling on the meaning of the single entity rule, which is the core rule in consolidation. And the elaboration really is just an addendum to the document. And it says, look, we really mean it. We know what it says. We still think we're right. We really mean it. And let's just everybody keep playing the game according to the rules that we thought we all understood. All right, so the single entity rule in consolidation, I think, does that. It says to the subsidiary members, sorry, you've just evaporated into thin air. It's like a trick on Penn and Teller. But once you've done that, once you've said to the subsidiary members, you no longer exist at law for tax purposes, well then, what's happened as a result of that? Now, some things you would think are pretty obvious. One of the things that happens as a result of saying those companies no longer exist is that they don't earn their own income, they don't incur their own deductions, they don't own their own assets and claim their own depreciation, and so on. There is no separate computation of taxable income in the hands of the individual members of the group. That's pretty obvious. They don't exist. The taxpayer's that other guy. It's responsible for what's happening. The ATO takes matters somewhat further and says that the domain of the Single Entity Rule Act also extends to some matters of tax administration and compliance. This seems inoffensive enough, though I'm not sure they go to the core purposes of the consolidation regime, but we can let that pass. I don't think that does any harm to anybody. But the implications of the single entity rule have been taken even further by the ATO in ways that strike me as somewhat misconceived. And an example here is the Meyer Emporium transaction. Now, the Meyer Emporium transaction is a relatively straightforward deal. I've lent somebody money, they owe me interest, I take the interest coupon and I sell it to somebody. That's the deal. Now, I've already given away the game by saying I sell it to somebody. Okay. Now, the transaction was analysed by the High Court and at long and tedious detail on the basis that that transaction was a sale. I was owed an interest coupon. That's an item of property. We're not talking near expectancies here for all the equity lawyers We're talking things that are presently existing shows in action and can be sold and was sold for a price. Everybody thought sale. But then the ATO issues a couple of determinations. And the determinations say, well, but actually, if the seller of the coupon is a subsidiary member of a consolidated group, then the income tax law will treat treat that transaction as conferring rights under the debt in a non-group entity as the borrowing of money or obtaining of credit. So I thought I was selling a coupon. The ATO says, no. Because this is happening inside a group, it's now a different deal. It's not a sale, it's a borrowing. Well, for people with even a modest kind of appreciation of income tax, that makes all the difference in the world. If I'm not selling you something but borrowing money from you, I don't have any tax problem to worry about unless and until something happens to the principal of the debt, and that's many years in the future. Well, what just happened to explain that? And the logic of the ATO apparently stems from the idea that if the subsidiary doesn't exist, then it cannot be holding an asset, which is the receivable that it is holding from another group entity. Okay, well, so when it sells, it can't be selling. It must be buying. You don't exist. You can't own your assets. You can't be selling. You must be borrowing. Right? That's the logic. Now, that logic does not have a lot to do with the deeming that ordinarily is understood to occur, which is we compute the consolidated income on the basis of the aggregate whole. We've changed the taxpayer to now the deals are different. Now the deals are different. Right? Now that is weird because at the same time, the ATO issued other documents which said, by the way, when a subsidiary member sells shares in another group company, that's a share sale. It's not a share issue. You say, well, hang on. If the issuer of the shares and the holder of the shares just evaporated, and we said that meant they don't owe money and are entitled to receive money, why is that not the case when they sell an existing shareholding? So there is no explanation in any of the documents about why the single entity rule changes the nature of one transaction but not the other transaction, nor is the inconsistency with Meyer Emporium addressed. But that's the problem with principles. Where do they lead you? I could have made the same point using Section 124 of the Corporations Act. When I was a student, we learned that the powers of companies, so this is the company lawyers in the room, we learned that the powers of companies to pursue their objects were what was set out in the Articles of Association of the company. And for most companies, that was going to be found in Table A of the 4th Schedule, in my case, to the Companies Act 1961, New South Wales. A fine piece of legislation, let me tell you. Now those rules have been replaced by Section 124 of the Corporations Act, much to my surprise, which says a company has the legal capacity and powers of an individual. That's the rule. Forget Table A. A company now has the legal capacity and powers of an individual. So what just happened? What just happened? I'll be interested to see if the local vicar will marry me and my company next Saturday. I'm also interested to see whether Constable Plod will turn up on Sunday morning and charge me with bigamy. I'm also interested to see whether the sheriff will be interested in having my company as a juror in a trial in a couple of weeks, or whether the army will call up my company for a rifle or probably drone brigade, or whether my company will be able to sue for nervous shock, right? The problem with all of these unadorned principles is that one never knows how far they go, which leads to the problem of unintended consequences. Vague rules can just do too much. If the subsidiary member of a consolidated group doesn't exist for tax purposes, then how do you do the transfer pricing if it has borrowed money from an offshore company? Okay. The creditworthiness, the rate of change, so this is one for you, Mr. Bowman. So the rate at which a borrowing would happen within by any entity will typically be determined by its own creditworthiness, unless there's some promises or security, some guarantee or security offered by other members of the group. And that makes sense because the parent isn't going to be on the line to repay the borrowings done by the subsidiary unless there is some reason for the parent to want to feel particularly benevolent to the creditors. But if the subsidiary members don't exist, whose credit rating should we be looking at? Should we be looking at the parent, okay, because the subsidiary doesn't exist, or do we still apply the credit rating of the thing that is actually doing the borrowing, is the thing that will be sued because this is tax-only land, right? Can the borrower still be the subsidiary, or must it be somebody else? So consolidation may take you to odd places. The deal you thought was the deal is a different deal. The person you thought was the person whose creditworthiness we're assessing might not be the right person afterwards. Hopefully the lesson is clear, even if the examples are not. The first principles are just not easy to capture. And secondly, if you're going to try to capture a principle, it's not always obvious what they imply or where you stop playing make-believe. Part 2. Is vagueness in tax law a virtue? As I mentioned above, I thought I'd use the opportunity of this lecture as the impetus to force me to consider more carefully the arguments advanced by some very serious scholars about vagueness and indeterminacy. And there are oodles of them. One only has to look into linguistics or epistemology or semantics or philosophy of language and ethics. And that's before one gets to the legal scholars like Jeremy Waldron, H.L.A. Hart, Ronald Dworkin, Joseph Raz, and Timothy Endicott, who I mentioned earlier. Even tax lawyers have been known to venture into this territory. I wanted to use the occasion of this lecture to force myself to read some of that literature to see if it had any resonance with my experience in that part of the world that I inhabit and am prone to call the real world. Now, Endicott, to his credit, does not start with a full-throated defense of the value of vagueness. Instead, he starts from very orthodox territory. Vagueness seems repugnant to the very idea of making a norm. It leaves conduct to some extent unregulated, when the very idea of making a norm is to regulate conduct. A vague norm leaves the persons for whom the norm is valid with no guide to their conduct. And the point of a norm is to guide conduct. A vague norm does not control the officers or officials responsible for applying the norm to resolve disputes. And part of the value of a system of norms is to control the conduct of persons. That all sounds very fair and entirely unremarkable. But he does warm to his theme. Vagueness can be valuable to lawmakers, and valuable to them because their use of it is valuable to the people to whom the law is addressed. And I was with him until the very last phrase. I can readily agree with the first sentence that vagueness can be valuable to lawmakers. To use Ross Parsons' words, vagueness spares drafters too much of a drain on their creative imagination. But when he says vagueness is valuable to lawmakers because their use of it is valuable to the people to whom the law is addressed, at that point we part company. Brett, tell them you'll be a bit late. I can't think of a situation where I've thought, gee, I'm pleased they wrote that so opaquely, because otherwise I never would have understood it. And then he goes all in. Far from being repugnant to the idea of making a norm, vagueness is of central importance to lawmakers It is of central importance to the very idea of guiding conduct by norms. So Endicott is an enthusiast. There are several strands to his arguments. I'm going to pick just three. The first argument is imprecision is valuable because it can avoid arbitrariness. All right. Second idea, there are lots of scenarios where precision is simply impossible, in which case a vague rule has the advantage that it delegates power to make decisions to persons who are better positioned to make them. And the third proposition is imprecision may induce desired conduct more effectively than a precise rule. And I think there is a grain of truth in all of them, though I remain unconvinced. A large part of Endicott is about the relationship between arbitrariness, precision, and imprecision. He wants to challenge the standard orthodoxy, which I take to be the idea that a precise rule leads to the rationality of rule-governed decision-making. He challenges that orthodoxy by arguing vagueness can avoid arbitrary outcomes that precision can bring. The starting point for understanding the potential value of vague standards is to see that both vagueness and precision bring with them forms of arbitrariness. This is a plague on both your houses argument. But the idea that deliberate vagueness can avoid arbitrary outcomes is a key plank, but to criticize an outcome on the basis that it's arbitrary requires an appeal to something else. It requires you to identify a meta-norm. It's arbitrary because it doesn't accomplish what the rule accomplishes. It should be accomplishing this other thing. Now, where that meta-norm comes from, God only knows. But regardless of where it comes from, the idea that there is always some overarching purpose which is better achieved by adopting a vague norm doesn't have a lot of resonance for me. One problem with appealing to the meta-norm is that, dirty secret of tax lawyers, a lot of tax law is simply arbitrary because it's dealing with drawing arbitrary boundaries, making artificial distinctions, and reflecting compromises. Okay, there is no deep policy behind the idea that the value of a free car space given to a worker in the CBD is set by reference to the lowest price charged for all-day parking by a commercial car park operator located within 1 kilometre of the car space on April Fool's Day. All right? There is no deep policy behind the idea that the value of the free lunch given to the client in the partner's dining room is $30 and has been since 1997. Right? There is no deep theory there. Endicott gives some examples of precise rules, which he says are not arbitrary, or if they are arbitrary, they're nevertheless desirable. And he gives the example of voting age. So setting the voting age at 18, rather than, say, a rule which says when a person's developed the mental acuity to assess candidates' competing policies and the personal fortitude to withstand external pressures, which is what the alternative might have been. Or determining that drunk driving will be decided using a blood alcohol concentration of 50 milligrams of alcohol per 100 millilitres of blood, rather than the kinds of sobriety tests that used to exist. These rules are arbitrary, but somehow he says they're different because they allow a quantitative standard to be applied. Okay, now I would say it rather differently. I would say those rules are well crafted and effective precisely because someone chose to formulate them in a quantitative way. Those formulations were not ineluctable. They're not inexorable. Somebody chose to say, we're going to do it this way, and it's going to be precise. They are arbitrary, okay, but they work. It's like Hawkeye. When was the last time you saw a fight over a line call at a tennis match in Australia? And there are other replies to this argument. Often, if there is some overarching consideration, it's not expressed or observable, it has to be inferred. And even when the overarching principle is expressed, our legal system is still suspicious. Our statements of object are still routinely quizzed, and I guess here I'm thinking of the way section 45B1 is just overlooked in 45B disputes. Again, another little throw out to the tax folks. The guidance one can gain from contemplating intended policy is often quickly exhausted. Overarching principles sometimes appear to be highly malleable. And here I'm thinking of the proposition that it was always part of the design of the imputation system that franking credits would be wasted. Okay, go looking for that one. If you can find it, I'll give you $1. And of course, policies and objectives change over time. Legislation doesn't always keep up. So if we are to interpret legislation by reference to policy, was it the policy when the legislation was enacted or the policy that we're now attempting to capture? But Endicott is about more than arbitrariness. He argues in some instances that precision can be impossible, and he gives the example of negligence. And I think it's certainly true that it would be impossible to codify the law of negligence by dedicating a reasonable amount of resources. But what do you do faced with that realization? Do you simply throw up your hands and say, because we can't do it thoroughly, we're not going to try at all, which appears to be his argument? I think that lets our legislators off the hook. He also makes the argument that, well, vague laws devolve responsibility to people who are best placed to make decisions about them. But then he seems to be a little bit cautious about where that leads. He says it's not instantly apparent whether these allocations of power are good in themselves or are an unfortunate byproduct of the need for vague standards. So he recognized that vagueness has got the potential to do damage to the rule of law. If we're to be governed by law rather than fiat, there must be constraints which ensure that the rule is not simply the whim of the regulator. That means there must be some criterion external to the will of the official against which the validity of a decision or an act can be tested. The last argument is this, you call that a knife argument, right? The idea that a vague norm is the best kind of deterrent for unwelcome behaviour. And I think this is undoubtedly true in tax land. It's the reason we've got Part 4A. Section 260 was seen to be a toothless tiger. Nobody's afraid of toothless tigers. Part 4A would inculcate an appropriate level of apprehension into the minds of taxpayers and their advisors. Draft an anti-avoidance provision as a roadmap with precision, as in the mall, and you can see that it is likely to end badly. But while as a positive proposition, it might be true that a vague rule is more terrifying than a precise one, query whether as a normative matter, we want to live in that kind of world. I think it's unpalatable for Parliament to say, I'm going to deliberately obscure the standard against which you will be judged, and I reserve the right to punish you for breaching it. That's the way my mother ran our household. Right? I don't know what you're going to do, and I don't know how you're going to do it, but I tell you now, you won't get away with it, Graeme. All right? Okay. You okay, Rebecca? Okay. Let me just. I'm conscious that I have exhausted my time, so let me just make a couple of other points. The people who were the drafters of the regimes that adopted principles-based drafting were much less reticent than Endicott. Endicott's arguments, I think, are wrong-headed, but they are modest claims. The claims made by the drafters of the TOFA rules were just ambitious. They said this drafting would be comprehensive. It would capture everything. It would be adaptable because norms would be fluid and they would be able to deal with new circumstances. They would better articulate policy. That's not really what they meant, because they go on to say there would actually need to be policy to be captured. So really what he's saying is it would force politicians to think about what they were doing, which is a slightly different point. There would be legislative efficiency because tax laws would be shorter, simpler, and more stable and need fewer amendments. Yeah, that's worked out well. laws drafted this way would be more certain because principles would be clearer and admit of fewer areas for dispute. I don't think we've seen any evidence to that effect. There would be better adjudication because judges will apparently find it easier to understand the intended target of the rule if it's just made a little bit vaguer. And there would be less scope for avoidance, which I suspect is probably true. Well, I don't think there's any convincing evidence, and in the written version of the paper, I go into some of that, but I'll spare you that. I don't think there is any evidence to support arguments about fewer disputes, kind of better adjudication, and so on. So having considered the arguments of Endicott, I remain wedded to a few very conservative, very traditional, but I think very important ideas. Precision is an aspiration, not a defect. Imprecision might be useful for drafters, but it often causes confusion and is apt to lead astray, which means vagueness is undesirable where it can be avoided with reasonable effort and at an acceptable cost in terms of drafting resources. It's also undesirable because it smacks of delegation to the regulator, and that practice is not desirable even in the presence of judges. And the reason for that is that our judges in our legal tradition are unwilling to reassess the merits of decisions bequeathed to regulators, instead focusing on administrative error, which is only a mild curb on the regulator's actions. So, changes that I would hope to see would require abandoning some existing fashions. We'd have to have a new black. But there is cause for hope. The drafters of Rethink cast doubt on the simplicity through drafting experiment. They said, while useful in addressing a particular aspect of complexity, the overall value of simplifying the drafting of legislation with any change in underlying outcomes is questionable. Simplifying language can only do so much. Which brings me full circle, back to my 25 years of tendentious, ponderous articles. I cling to the fond notion that the person in Treasury who wrote that passage in Rethink had read all of those articles and found my work compelling. And don't disabuse me. As I said at the beginning, I've had the honour of being asked to do a couple of these lectures. The third golden rule that one should adopt, I fear I have broken. The third golden rule is the speaker always finishes on time. I did my best. Thank you for coming. Thank you for your attention.
Thanks, Graeme. I'll say a few more things in a moment, but for now, I'll just ask Miranda Stewart to say a few words on Graeme's thoughts, which I very much enjoyed and I actually agreed with.
Thank you. Actually, I was given 15 minutes. So whether I use all that, we'll see. Hi, everyone. It's Miranda Stewart. I'm from the great state of Victoria. The only comment I'll make on the state of Victoria is that we are, as people well know, tolerate diversity, dissent, eccentricity, and we have better food and wine in general, and appreciate that. That's down here to say there. So it's an honour to be invited to be the discussant on Graeme's magnificent lecture. I should also extend my acknowledgement to the traditional owners of the land, and I am visiting from the lands of the Wurundjeri people of the Kulin Nation on which Melbourne Law School stands. And given that it's International Women's Day, I'd also like to acknowledge and pay my respects to the great women tax lawyers and scholars in the room, some of whom also taught me. Actually, Graeme never did teach me, but I'm lucky to be able to say that Graeme hired me. in his sojourn, which Richard so rapidly passed over at Melbourne Law School, when he was leading reconstructing, and one would have to say fully reinvigorating the master's program and also teaching tax in the LLB at Melbourne University. I was at New York University at the time, spending some time in the US as well. Graeme offered me a job in 1999. He very generously, on my request, then agreed to delay the start date by a year, no doubt gritting his teeth as he taught across 10 subjects in the Masters. I now sympathise with this situation, so I could stay there for another year. He also, and I don't quite know how he achieved this, managed to offer me higher status and higher pay than Sydney Law School. And being responsive to economic incentives, as I am, that probably clinched the deal in terms of me going to Melbourne. Let me say I was responsive to the wage and not to the tax rate on the wage. It was really the wage and the job itself that mattered. So thank you, Graeme, for that. It's not overstating it to say that Graeme, of course, led the development of that tax master's program, which has gone from strength to strength. He did promptly repay me for my extra year overseas by allocating me to teach that entry-level graduate course, Taxation of Partnerships and Trusts, in the Masters. You can see I'm not going to say anything about the lecture itself, but I felt like I've got a couple of thoughts on the lecture, but I did feel like I had to share a couple of these things about Graeme's career as well, some of which might be familiar to some of you who have been students of Graeme. I do recall sitting in on Graeme teaching the advanced tax class to the LLB students. They were shocked, but they ultimately learned to love the inundation of corporate tax, controlled foreign corporations and financial tax rules that they received in that course, beautifully taught and acerbically critiqued. I should also say that Graeme also encouraged me to teach a subject called tax incentives for industry and investment, which subsequently fell off the books as these things became less important and maybe is perhaps going to reappear. But one of the things he introduced me to then is the concept of tax arbitrage and the role of the incentives, and that has been and remains really important in how we think about how the tax law operates in the real world. Okay, so let me come to the brilliant lecture. So of course, Graeme's critique, like that of Ross Parsons, of course, is rather caustic, but I can assure you it comes from a place of love. So he observed in the lecture that the income tax is more important than ever before. And I think the statistics point that out. So the reason he excoriates the law, or perhaps those responsible for drafting and implementing it, is because it's important. It's really important. And that would also be my view. Ross Parsons, rather surprisingly in some ways echoes the words of Joseph Schumpeter 100 years earlier, the political economist in Austria and the US, who also thought that the income tax was on the way out, was actually more suited to the 19th century and would be replaced by a broad-based consumption tax in the 20th century, suitable for the mass industrial economies and mass consumption of the day. So of course, Schumpeter, like Ross Parsons, was half right and half wrong. We did get broad-based consumption taxes. Turns out, except in New Zealand, they were not as broad-based as everybody thought they would be. And there are some very good reasons for maintaining and protecting and improving constantly the income tax, which is, I take it, the reason we should be critiquing it. I must say, I would like to hear Graeme's rendition of Forex realisation event to set to music. You cease to have a right or only part of it. So, the reason why we have to critique this and the reason why we should care about the words and the structure of the income tax law is that it remains fundamental to our, I would suggest, democratic system in this country. So Graeme, as he explains in the lecture, having critiqued words, is really more interested in this defective jigsaw, right? The design and structure, the way the different elements of the law fit together. And I would say, and I think this is something he'll tell me later if I'm wrong, of course, so I'm completely assuming, but the goal, as it seems to me that tax law should do, and I think I read Graeme as saying this, is that we need to be connecting the law to reality in some way. And I actually think this was one of the things John Preble was also interested in, although he used an even more arcane language of ectopic, some of you will remember, and autopoiesis, which was rather hard for many of us to grasp. But he was also talking about the relationship of the tax law to reality, to the sort of economic and social transactional market activities of the day, right, of the time in which we operate. Of course, that's why the tax law never keeps up with what we try to achieve, because these things change faster than the law can change. But it is therefore a distraction to think that just words or just principles can solve our problem, which is always about connecting the law to the economic reality. You know, we've had some examples from Graeme from Forex and consolidation and these other pretty kind of complex areas of the tax law, people will know. We could give many others in more kind of humdrum areas of the law. I've just finished teaching the introductory tax law course to our master's students. Many of the students are international and bring substantial experience from their own countries, but know nothing. Our babies in our income tax law. Now, of course, we do sort of succeed in levying a capital gains tax in Australia, but it does remain the case that explaining the existence of 50 CGT events to international tax law experts is impossible. I mean, they just like, why? Why do we do? I have no answer. Similarly, depreciation. I mean, I still struggle to articulate the reasons for listing the owner, still the most common way we hold assets. I know leasing's important, you know, but the owner of a depreciating asset has item 10 in a table after all the other possible ways you might, you know, get access to an asset. Or I always have to look again to find the definition of cost of an asset being what you paid for it, as Graeme said, money, in a section after an awfully long list of other ways in which you might exchange value for an asset or be treated as having an asset of value, and kind of almost as an afterthought. You know, I guess this relationship to reality is still a challenge, of course, is how to do it. But after many years of sort of trying to think, well, is there a better way to phrase it? I must say, agree with, I quite like the idea of using ordinary words. I mean, the biggest challenge probably to us these days has been the move away from property, concepts of property, to assets in some broader sense of financial value. And I think this is a challenge not just for tax lawyers, this is actually a challenge for property lawyers. It's actually been a challenge for property law to keep up with understanding where the value is. What does this mean? And so I do understand why drafters try to capture something different about the meaning of value that goes perhaps beyond what the law might at the time say is property, which is not to say that that's an easy task or that we've succeeded. So just on vagueness, Professor Judith Frieden gave that lecture. I think it's fair enough to say that Judith's engagement with Timothy Endicott's work on vagueness is primarily from her lens of anti-avoidance, because this is something that she has a particular interest in and has written about. Graeme didn't mention his own work, but of course he has written very influential work about the rule of law and certainty and anti-avoidance. I do think that there is something to be said for interpreting Part 4A as injecting a kind of necessary element of vagueness or imprecision into what we hope is more or less precise tax law. But I don't really like the word vague, I must say. I haven't read Timothy Endicott at all, but my preference is that it is something, it requires judgment. We have to exercise judgment about whether we will respect this transaction or that, whether we will respect the intention that we identify as the intention of the taxpayer, rather than saying it's vagueness as such that it characterises an anti-avoidance rule. And I think there's some merit in having rules in the tax law that require judgment. The question is how we hold that judgment to account. I do share the concern of Graeme about non-binding administrative guidance and relying on administrative guidance to kind of fix problems in the legislation. And we can see this issue in the current attention to the Commissioner's general power of administration that the Inspector General is now doing an inquiry on. We can't rely on this power of administration to fix problems in the law. I mean, we really do have to actually pay attention to the law itself, even if drafters don't want to do that. Okay, just to finally sort of wrap up, if we have a think about this idea that we do need to be concerned with the law, maybe what we could also do is connect this with sort of the latest developments about algorithms and automatic decision making, and the idea that this can achieve better administration or better precision. We have the tax lawyers and tax officers have the salutary lesson before us of the robo-debt scandal and the Royal Commission that is currently going on, which was, of course, a precise algorithm incorrectly implementing a precise law. So, we can't rely on automation or algorithms, especially if they are not going to take the law seriously. And I think one way for us to respond to that risk is actually ourselves taking the law seriously, that it actually should most of the time do what it says, right? Rather than expecting some other system or decision maker to do the work for us. So just to kind of finish on that automation note, I don't know if anyone noticed that recently a US professional asked ChatGPT to provide tax advice in a range of situations to see what it would say. And I'm pleased to tell you that ChatGPT got the answer wrong 100% of the time. So you're all quite secure, as clearly AI is not the answer. The tax law is not structured in a way that is logical in the sense that a computer that doesn't make it wrong, but it's not structured in a logical way because it's actually, again, intended to match, to fit with what is actually imperfect, and that is the way we do things, the way we do things in the market, the way we buy and sell things, the way we enter into legal transactions, and then the way we write law. So in this endeavour, I think we can all learn from Graeme's career and his long writings on these things. I commend them to you. I'd like to congratulate him on his retirement, noting that it's only from full-time teaching, which is a pretty bizarre way to retire, I have to say. But I hope to read and hear many more acerbic opinions from Graeme on the income tax or other things over many years. Thank you.
Thanks, Miranda. I thought I didn't say anything personal about Graeme before, and I thought I'd say some of that to the end, but Graeme is quite a private person. So everyone's got a story about him, but every story is completely different, reveals some new facet of Graeme that you didn't know about. When I was at the OECD and Graeme was coming to the OECD, we were in the wilds of what was then the former Soviet Union. I was in Tashkent in Uzbekistan, and I sent Graeme off to Bishkek in Kyrgyzstan to help them advise them on a tax system. And Graeme came back and he was talking a bit of whatever they talked there. It's one of the things. Wherever he goes, he tries to learn some of the language, and he's now deeply into Japanese lessons. This is one of his hobbies in retirement, is becoming proficient in Japanese. And it didn't matter which country we went to. Before we got there, Graeme had some of the vocab and the expressions already. Again, somewhat surprised me because he didn't strike me as sporty sailing type. But Graeme loves getting out on the water, canoeing or kayaking or owning a sailboat, and doing those kinds of sporty things. He also enjoys food and wine like most of us, and we're going to get there in a moment. But before we do that, I just have a few people to thank and one group to note. We actually have in the room with us 3 or 4 descendants of Ross Parsons, 2 of his daughters and 1 of his grandchildren. So Janet and Rosalind, where are you? Yeah, the back, and Michael. Okay, so make yourself known to them. They still have Ross's book on their shelves, and they're still promising themselves they're going to read it someday. I'd like to thank the Dean for funding the event out of the Parsons Fund. I'd like to thank Carla and Michael Durkis for organising the event. As I said at the start, I didn't do any of the organisation. I was just asked to speak. And I was also asked to tell you that when we go out there to eat and drink, there's actually a gallery that you can walk around. This is the new University Magnificent Gallery. You go out, I was surprised when we were coming in, just to the right of where you come in, there's this big yellow bit of canvas on the wall, it looks like. And if it's an original Keith Haring, which I think it is, it's worth millions of dollars. What's it doing sitting there right at the end? Hanging by a bit of string as far as I could tell. The university actually has a wonderful art collection, antiquities collection or whatever, and you can go and see a bit of it while you're here. And then having done that, you should actually come back and look at this museum. It is, and it's free. So it's a wonderful place to become acquainted with. So this floor and the floor below, you can just wander around with your drinks and canapes. Please don't steal the art. Just look at it. Thank you very much for coming, and I look forward to talking to you over a drink. Last thing of all, a present for Graeme. Thank you, Graeme, for a wonderful lecture and for a wonderful career.